Okay, so hello my dear students, welcome to another discussion for accounting for business combination. So in this video, we shall be discussing accounting for stock acquisition subsequent to the date of acquisition. Okay, so IAS 27 set out different methods in accounting for the investment in subsidiary account in the separate financial statements of the subsidiary subsequent to the date of acquisition. So the investment in subsidiary account may be accounted either in cost model, equity model, or other method in accordance with IFRS 9. Okay, but here we will be discussing a difference between the cost model and equity model in accounting for the investment in subsidiary account in the separate financial statements of the parent. Okay, so under cost model, the parent will not record any share in net income and share in net loss of the subsidiary. However, if my cash dividend, the parent will record this as debit to cash and a credit to dividend income. Okay, so in equity model naman, so the parent will record its share in the net income and the net loss of the subsidiary. So, if there is net income, so yung entry ni parent, is a debit to investment in subsidiary account and a credit to investment income. However, when there is net loss, it's a debit to investment income and a credit to investment in subsidiary. However, pag may dividend received from the subsidiary, okay, i-debit siya to cash and a credit to investment in subsidiary. So, para siya return of investment. Okay, so to summarize, under cost model, okay, the investment account, subsequent to the date of acquisition, okay, so, hindi mag-change, diba? Hindi siya mag-change since the investment account will be reported at its cost or its cost at the date of acquisition. However, in equity model, so mag-increase siya if may share in net income, mag-decrease siya pag may share in net loss, and mag-decrease if may to record the share in dividends. So therefore, mag-change ang value ng investment account in equity model unlike sa cost model. Okay? So, one of the important formulas in or computation in accounting for stock acquisition subsequent to the date of acquisition is to compute for the consolidated net income and net income attributable to parent, and to compute for the consolidated retained earnings. Okay, so the consolidated net income or the net income attributable to parent is actually the parent's net income plus the parent share in the net income of the subsidiary. Okay, so to compute, we have here the net income of the parent less plus the net income of the subsidiary. So this is actually the net income reported in the separate financial statements of the parent and the subsidiary. Okay, from the net income of the parent, we shall deduct any dividend income and investment income from the subsidiary. Okay, so to determine the net income from own operations. Okay, so i-remove mo lang yung dividend income. Kasi di ba you are preparing consolidated financial statement. So dapat i-deduct mo yung i-report ni parent na income from the subsidiary. Okay? So the difference lang kasi di ba in in accounting for stock acquisition at the date of acquisition, the stock acquisition, is that in the subsequent to date of acquisition, there are transactions between the parent na and the subsidiary, no, which shall be eliminated if it's intercompany, no. So that's why yung dividend income na report ni parent, no, from the subsidiary or any investment income will be deducted to determine the net income from own operations. Okay, and also we are to add or deduct any amortization of excess. Okay, so since diba, in the books of the subsidiary, all its assets and liabilities are recorded at book value. However, when we do consolidated financial statements, diba, it should be at fair value. Okay, so any difference between the fair values and the book values of the assets and liabilities of the subsidiary, no, will be amortized. No? Also, yung excess of the fair value and the book value of the assets and liabilities of the subsidiaries na nag-exist at the date of acquisition shall be amortized. Okay, of course, it shall be deducted from the net income from own operations of the subsidiary. Okay. Okay, so say for example, no, for undervaluation of assets. Okay, undervaluation of assets. Okay. For assets, so we have depreciable assets and non-depreciable assets. So say for example, we have depreciable assets such as equipment, you know, such as equipment. Okay, so say for example, its fair value and its book value. Its fair value is 200,000. Okay, its fair value is 200,000, and its book value is let's say 150,000. Okay, so the equipment account is undervalued, diba? Undervalued siya by how much? So undervalued siya by 50,000. Okay, so the excess is actually the 50,000. Okay, let's say for example that the equipment has a 5 years remaining useful life. Okay, 5 years remaining useful life. Okay. Since the equipment has a book value of 150,000, okay, so the depreciation reported by the subsidiary is actually 30,000. Okay, but since its fair value is 200,000, the depreciation for consolidated purposes, okay, should have been 30,000. Should have been 40,000. Okay, so therefore yung depreciation expense natin, yung depreciation, okay, depreciation. Okay, so yung depreciation natin is understated by 10,000. Okay, okay, so yung depreciation natin is understated by 10,000. So what will happen if our depreciation is understated by 10,000? Therefore, the expenses of the subsidiary is understated. Kasi it recorded 30,000 lang kasi of depreciation. No? Kasi of course, its depreciation is based on the book value. However, in the consolidated financial statement, its depreciation should have been 40,000. So therefore, in the preparation of the consolidated financial statement, so the depreciation expense should be increased, no, by 10,000. Okay, so since the expenses of the subsidiary is understated, no, therefore its net income is overstated. Okay, that's why we are to deduct any undervaluation of an assets. Okay, so that the excess depreciation of 10,000 will be amortized for 5 years. So, every year, no, so mag-deduct ka ng 10,000 in the net income of these subsidiaries in relation to undervaluation of 50,000, no, for the equipment. Okay? In case of non-depreciable non-depreciable assets such as inventory, such as inventory. So if may inventory tayo, let's say for example the fair value of the inventory, the fair value of the inventory is 15,000, but its book value is 10,000. Therefore, undervalued siya ng 5,000. Okay? So, if in case, ito siya, what will happen? Its cost of goods sold, no? Its cost of goods sold should have been 15,000. Kasi its book value is 10,000. Therefore, it report once the inventory is sold, no, subsequent to the date of acquisition. Okay, so but if its book value is 10,000, so it shall be reporting cost of goods sold lang at 10,000. But however, for consolidated purposes, the cost of goods sold should be 15,000 kasi nga the fair value of the inventory at the date of acquisition is 15,000. Okay? So therefore, its cost of goods sold is understated. No? So therefore, its net income is overstated. That's why we are to deduct, no, the undervaluation of the asset. Okay? So, next would be the overvaluation of some assets. Okay, overvaluation of assets. Okay, let's say for example, okay. Okay. Example ng overvaluation of some assets. Okay. Gawin natin itong 150,000. So, gawin natin 200,000. Okay. So, this becomes overvalued. So, overvalued. Okay. So, assuming pa rin that the useful life is 5 years. Okay. So, its fair value is 150, but its book value is 200,000. So, actually, the equipment, no? So, yung equipment natin is overvalued by, assuming it's equipment. Okay? So, the equipment is overvalued by 50,000. So, its fair value is 150 and its book value is 200. So, assuming pa din that the useful life is 5 years, diba? The useful life is 5 years. Okay. The depreciation reported by the subsidiary is 40,000 kasi its book value is 200, that's 200 divided 5. Okay. And then, but its fair value is 150, so dapat yung depreciation is 30,000 for consolidation purposes. Therefore, our depreciation is overstated by 10,000. So if our depreciation is overstated by 10,000, then the net income is understated. Kaya we need to add 10,000 in our net income. Okay? That's for 5 years over the remaining useful life of the equipment. Okay? So, if example, if it's a non-depreciable asset such as inventory, okay, say for example, its book value is 10,000 and its fair value is 15,000, okay. So therefore, that's overvalued tayo. Yan. Overvalued tayo by 5,000. Okay, overvalued is 5,000. So therefore, the subsidiary reported cost of goods sold at 15,000, but for consolidation purposes, the cost of goods sold should have been 10,000. Okay, so therefore, our cost of goods sold is overstated. That's why understated yung net income natin. So, for amortization purposes, we shall add the overvaluation of the inventory. Okay? So, what if land, no? So, what if land yung na may excess? Okay? So, since land is non-depreciable, is a non-depreciable asset, so walang amortization of its excess. Okay, so unless yung land is sold to outside parties. Okay, so that's actually the undervaluation and overvaluation of our assets. Okay, so let's have undervaluation and overvaluation of liabilities. That's undervaluation and overvaluation of liabilities. Okay. Let's say, for example, bonds payable. Bonds payable. Bonds payable. Okay. And bonds payable. Okay, so yan no, what if yung bonds payable natin has a fair value of 200,000 and then yung book value ng bonds natin is 150,000. So again, it's undervalued by 50,000. Okay, let's just also assume that the term, so yung life ng bonds natin is 5 years. So, yan. Okay. So, this is undervalued. So, diba undervalued to. So, so if the fair value is greater than the book value, is actually the excess shall be treated as a premium on bonds payable, diba? So, premium on bonds payable. So, how do we amortize for this excess? Okay? So, pag amortize, how do we amortize premium, diba? So, yung entry natin, when we amortize premium, so we debit interest, we debit premium on bonds payable, diba? And then we credit interest expense. So, assuming a straight line method of amortizing our premium. Okay? So i-amortize natin siya for 50,000 over 5. Okay? Yan. So, ano yung effect? Ano yung effect ng pag-amortize natin ng premium? Okay? Our interest expense will be credited. No? Okay, so ang effect ng pag-amortize ng ating interest, pag-amortize ng premium bonds payable will increase net income. Okay? It will increase net income since, diba, it will reduce our interest expense. Okay? So, what if, no? Overvalued yung liabilities natin. Okay? Overvalued. Okay? And, for example, overvalued. Gawin natin 150. 150 yung book value. So, yung fair value is 200,000. Okay? Therefore, our liabilities is overvalued. Overvalued by how much? 50,000. Sabi pa rin that the bonds, no? Yung bonds ay may 5 years, no? Na life ng bonds. Remaining term ng bonds. Okay, so, if the fair value of the bonds is lesser than the book value, so this actually, the difference will be treated as a discount on bonds payable. And discount on bonds payable yun siya, no? discount on bonds available. Okay. So, how do we amortize, diba? How do we amortize discount on bonds payable, diba? It's a debit to interest expense. Okay, it's a debit to interest expense in a credit to discount on bonds payable. Ito yung entry natin, diba? When we amortize discount. Okay, so but still 50,000 divide 5. It's actually 10,000. So, ano yung effect? Okay, ano yung effect? No? Ano yung effect ng pag-amortize natin? So, it will increase our interest expense. No? So, if mag-increase yung interest expense, it will decrease our the net income reported by the subsidiary. Okay? So, no? Yan. Okay? So, therefore, if there is any undervaluation of our assets, i-deduct natin sa net income. Pag overvaluation of assets, yan, i-add. Undervaluation of liabilities, i-add. And overvaluation of liabilities, i-deduct. Okay? To get our consolidated net income. Okay? Our consolidated net income is actually the net income, the adjusted net income of the parent plus the adjusted net income of the subsidiary. Okay? That's actually the net income of subsidiary. That's the amortization of all the excess. Okay, so if my my good impairment of the goodwill, of course, you are to deduct impairment of goodwill. So depende if my share was a parent or my share, then if my share si non-controlling interest sa impairment of the goodwill. Share to subsidiary. Okay, so we have here the consolidated net income. Okay, so if it's 100% acquisition, of course, all the net income of the subsidiary shall accrue to the parent. So walang share si non-controlling interest. However, if it's a partially owned subsidiary, or acquisition less than 100%, so my share si parent. May share si parent sa net income ni subsidiary. Also, may share din si non-controlling interest sa net income ni subsidiary. Okay, so therefore, sa adjusted net income of the subsidiary, i-deduct natin yung minus or the NCI share in the net income of the subsidiary. Okay? Yan siya. To determine the net income of the subsidiary attributable to parent. Okay, so therefore, our consolidated net income attributable to parent is actually the parent's net income, from own operations, or adjusted net income of the parent, plus the parent share in the adjusted net income of the subsidiary. Yan, yung diniduct na yung share ni non-controlling interest. So, therefore, our consolidated net income or net income attributable to parent is actually the parents adjusted net income and the parent share in adjusted net income of the subsidiary. Okay? Okay, so also to compute for the consolidated retained earnings, it actually in the first year of acquisition was actually consolidated retained earnings or retained earnings paying ni parent. I-add natin yung net income attributable to parent, okay? And then deduct natin yung dividend declared ni parent. It's actually the consolidated retained earnings N. So that's for the first year of acquisition. Okay? However, in the subsequent date of acquisition, okay, so yung formula natin is actually the consolidated retained earnings beginning, So kung ano yung ending balance last year, that's actually the beginning for the in the next year. Net income attributable to parent for the year, the dividend declared ni parent for the year. We have also consolidated retained earnings. And so if in case hindi natin alam yung consolidated retained earnings beginning, no? So we can actually compute this, no? How do we compute? Okay, so it's actually retained earnings beginning the parent. That's actually retained earnings beginning the parent at the date of acquisition. Okay. Yan, at the date of acquisition. Okay. Then, kunin lang natin yung increase or decrease in the retained earnings of the subsidiary. So, ano yung beginning retained earnings is subsidiary. Okay. Beginning retained earnings is subsidiary. Plus ending retained earnings is subsidiary. No? Yan siya. Kunin natin if may increase or decrease. Then, add or deduct natin yung previous year's amortization of the excess. So, that's a net increase or decrease in the retained earnings of the subsidiary. Okay? Kasi diba, yung eliminating entries natin or yung working paper eliminating entries natin, ano lang kayo, that's actually for consolidation purposes lang. So, it will not affect the separate financial statements of both the parent and subsidiary. That's why we always consider the amortization of excess every year. Okay, so then from the net increase and decrease in the retained earnings of the subsidiary, no, i-multiply mo lang siya sa controlling percentage, no, yan, to get the parang share ni parent sa increase in retained earnings or decrease in retained earnings ni subsidiary. So, it's actually consolidated retained earnings beginning. If in case hindi siya given, so we have alternative computation for the consolidated retained earnings. Okay? Also, to compute for your non-controlling interest, if in case it's a partially owned corporation, so you have here NCI beginning, no? NCI beginning, and then add lang natin yung share ni NCI sa net income of the subsidiary, less natin NCI share in the dividend declared by the subsidiary. Actually, that's actually the same computation, no, for the retained earnings. Just that i-add lang natin yung share ni NCI sa net income, then deduct share di NCI sa dividend si subsidiary. Nag-declare ni subsidiary. Kasi yung dividend, nag-declare ni subsidiary, no? If it's wholly owned corporation, so all the dividends will accrue to the parent. However, if it's partially owned, so pag mag-declare ng dividend subsidiary, may share din sa non-controlling interest. Okay? So, if in case then, na same thing, if hindi given yung NCI beginning, so it's actually NCI at the date of acquisition, then kunin natin yung increase or decrease in retained earnings to the subsidiary, less or add amortization of excess, then i-multiply natin sa non-controlling interest, no, na percentage. Then, to get the NCI's share in the net increase or decrease in the retained earnings of the subsidiary. No? Then, add natin sa NCI date of acquisition to determine the NCI beginning for the subsequent year. Kasi pag ito kasi, no, actually NCI begin at the date of acquisition. Kasi ito, conversion ito at the date of acquisition. Yan. NCI at the date of acquisition. Okay, so it's actually some of the formulas, no, in the accounting for stock acquisition. subsequent to the date of acquisition. Okay, so in the next video, so we shall be discussing some sample problems, no? Sample problems, how to prepare, uh, eliminating entries, no? How to prepare worksheet, no? For a wholly owned and partially owned corporations, no? Okay, subsequent to the date of acquisition. Okay, so thank you.